I'm going to start getting into the topic, which is sourcing deals in today's market. This is probably this is a tough market, as you may know, not only for your ever rising debt or loans, but you have a decrease in just supply on the market. You have cap rates that haven't really compressed all that much or expanded, excuse me, just meaning pricing coming down all that much, or at least expectations. You have a lot of these factors. You have rising insurance rates. You have taxes, property taxes that have increased wildly just based on the past couple of years of the sheer amount of transactions and price points. So we're going to talk about all that, as well as a few other things that I put here. So first and foremost, let's just talk about today's market versus last year's, right? So this year, we're probably at a fraction of the amount of deals that we have seen coming our way and we've implemented much more ways to actually source deals. We've come up with list of looming debt deals with looming debt. We've come up with sourcing directly from operators and owners. We've gone so many different routes, and even doing that, we still have seen the deal flow of new deals coming in our pipeline shrink maybe a quarter, maybe even a half of what it was last year. I think the main reason, obviously, as everyone knows, is just because of the debt that I just talked about. If you go to Pensford, I think this is a great resource to check out the treasuries, which a lot of the debt is actually based off of. So let's just talk about agency debt. You have Fannie, Freddie. A lot of their interest rates are based off the 5, 7, 10-year, which are listed right here. So these have gone up significantly in the past 18 months. And because of that, your debt monthly debt payment has increased by double, twofold, threefold, making your cash flows decrease significantly. So because of that, you obviously can pay less for a property to have this similar cash flows from previous years. And because of that, a lot of people are not able to buy, especially when the sellers have high expectations, right? They've been developers, merchant developers, builders, just normal operators used to be getting selling properties, Class A multifamily properties at a 4% cap rate. That's no longer the case. You can't have negative leverage like that, meaning your cap rate's 4%, but your debt is at 6.5%, which it really is today. So sourcing deals has become quite difficult, right? We're still contacting the brokers, having those relationships with brokers. And actually, you see a lot of deals that used to be on the market, used to be under contract, fall out of contract because of the debt increases. And you're seeing a lot of repeat properties and, I guess, business. So you're seeing a lot of the same deals. You're getting, obviously, those deals are pushing their NOIs, feeling that they can get, the same value that they had under contract, call it last year, which in part to that, you're seeing a lot of properties not run full marketed processes, right? So you're not seeing a deal being marketed last year also being marketed this year. You're seeing a lot of it come from multiple brokerages. So you'll have a property that was on market, fell out of contract, then you have four or five brokerage firms going to that seller and saying, listen, let me just go off market. So you're seeing a lot of off market opportunities nowadays. Now, is that truly off market? I'm not sure. I don't know what you want to define as off market, but at least it's not being blasted out to, an email chain and you have 1,000 operators looking at it. So pretty different. So I think having your relationships in place is super important for you to source those off-market deals. A lot of times they're calling me or PassiveInvest.com to present these opportunities, whereas me calling them. But I would say about half the properties are going off market at this time. I think another reason for that is just to not bother the property as much. If you think about it, right? If you put a property on market, you're having a lot of tours, you're disrupting the flow of the operations on site. If you do that for an extended period of time, it kind of creates a hiccup in operations slightly. So off market helps with that. You have less tours, you have a lot less questions of random questions or random groups coming in. So I think having those relationships in place is super important for sourcing those off market deals. Let's talk about where these off market or on market deals are penciling in a cap rate perspective. So again, I'm talking about Class A multifamily, call it 100+ units. We used to see, like I mentioned, cap rates actually go lower than 4% of in place. Now we're seeing deals trade maybe at around 5.25. So you have seen an expansion of some, but I think it's important to highlight that transaction volume is down 90% in some markets. Actually, I think most markets, but the actual statistic is if you go to Nashville, you go to Houston, these markets transaction volume perspective are down 90%. So if you had 100 deals transact last year, you had 10 this year. So the data points are a lot less, but I think based on the conversations I've had with both brokers and sellers and even other operators looking to purchase, your going in cap rate expectations as a buyer are significantly higher than last year, right? You're seeing, I think in a multifamily property, call it in Charlotte, is penciling probably around a 5 cap. And if you're talking about a built to rent community that is townhomes or duplexes or whatever it may be with an amenity set, you're seeing that anywhere from 5.25 to 5.75. And I'm talking 2015 and newer product. Now, if you go older than that, call it a Class B property that has a little value add play, you can see a deal trade upwards of 5.5 to 6%, even upwards of 6% in some markets, just depending on your debt, obviously, your insurance rates. So, for example, there's a deal in Houston, Texas that we're looking at that I'm getting quotes of insurance at $2,600 a door, which call it 18 months ago, that was at 800, 900 per door. So just things to consider when you're sourcing deals in specific markets. And I think you're actually seeing that a lot of deals that are transacting in today's market are in markets where you have a little bit more certainty on your property taxes. You have a little bit more certainty on your insurance rates. Maybe they're less coastal markets. You're having less transaction volume or more transaction volume in places where the property already has existing debt that the buyer can absorb. They can what's it called? A loan assumption deal. So I think a good example of a high transaction property versus a low transaction property in markets that are pretty close to each other. I'm going to give you two examples. You have Greenville, South Carolina, and you have Charlotte, North Carolina. Both are, call it 2 years ago, high transaction volume markets. And right now, Charlotte is transacting a lot more than Greenville. I think given the fact that there's more product, yes, and there's a lot more product coming online in Charlotte, sure, that's one thing, but take that out of the equation, you're still having a much higher percentage transactions in Charlotte because the property taxes in North Carolina on a 4-year basis, whereas in South Carolina, if you sell the property, they'll pick up that and they'll reassess you at the point of sale. So day one, your taxes in Greenville will increase, right? Number two, I think your insurance rates are a little bit more favorable in Charlotte than Greenville. Greenville actually is pretty low, but I think a better example would be Charleston, South Carolina, just because it's more coastal. You're about double the per door in Charleston, South Carolina than in Charlotte, North Carolina. And then lastly, I was going to talk about the loans, right? So in Charlotte, there's a lot more loan assumption deals happening right now, meaning that there's a loan that's fixed rate, call it 3-4%, that has 5-10 years left on the note, and maybe even some interest only. And the new buyer will take over that loan and just run its course through that. So just some ways of keeping track on specific markets. And as you're sourcing deals, you'll realize that a lot more deals that are on the market have better debt, that are a lot more transactable, have better insurance premiums, have better property taxes, etc. Okay, getting into the next bullet point of who is selling and why. Please ask questions as I'm rambling here. I'd love to answer any questions you may have, any specific questions. But who is selling the properties and why? I can talk about us as a company. We're actually selling a property this year. One's under contract, and the reason being is the loan assumption. So we're giving the seller the loan that's currently on the property. We're selling because it's ran its course, right? It's one of the oldest properties in our portfolio. We've held it the longest out of any deal. We're in the money on it. We're going to make some money, and that's why we're selling. So that's one reason, right? You have good debt. You've bought it well. You're going to sell it well. You're still going to make money, even in an environment like today. Who else is selling? You're seeing properties that are struggling with their debt, right? There's a lot of bridge debt out there that is soon to mature at the end of 2023, 2024, 2025. And you're seeing a lot of these properties that had valuations that were much higher than they are compared today when they were bought. They have higher leverages, called 70 to 80% LTV levels. And they either purchased a rate cap, or they didn't, meaning that their debt service payment has skyrocketed, and maybe they're not covering and they're losing some money per month and they need to get out of the deal. So you're seeing a lot of properties like that. You're seeing properties that sold maybe at 260 a door, now hitting the market at 200, 215 a door, for that exact reason, which is definitely an opportunity as a buyer. We've seen actually a handful of deals recently just like that, at the height of the market, let's call it, you saw that property transact at 260 a door. And now while we're in this tranche of value depreciation, you might have a great opportunity to get a great asset at a discounted price, on the basis. Maybe the numbers are a little tight, but that's just something to consider when you're sourcing deals. So those are the types of sellers. You've seen some defaults come into play as well. You've seen some markets where there's higher vacancy. Maybe the lender didn't require them to purchase a rate cap. All these different things. So that's a great opportunity to source some deals. Look at some maybe even lenders that sourced a lot of higher leverage bridge debt. There's some tools that you could do that. Yardi being one of them. Is a great way to look at DSCR rates as well as maturity dates. So just you have to come up with creative ways in today's market, obviously, to source some deals. We have come up with lists of debt maturing. We've come up with markets, like I just mentioned, that are going to transact much better, or their pro formas are going to be a lot better to underwrite when it comes to insurance and property taxes. So all these things we're considering. And I think a good example for a couple markets that we might have pulled back on recently that we used to buy a lot in is in the Florida and Texas, just because of these reasons, right? You have hurricanes coming in. You're seeing a lot less deal flow in these markets. And a lot of the deal flow is coming out of the Carolinas. So, oh man, that was long-winded. I'm going to take a breath. I'm going to take a sip of water. Please type up any questions you may have. I don't see anything coming in. Maybe I'm doing a good job. Maybe you guys aren't interested. I'm not sure, but don't hesitate. Okay, still not seeing much coming in. All right. Let's talk about maybe seller expectations and buyer reality. What does that even mean? Well, there's definitely a gap between the seller's expectation, where they think the market is. Maybe they haven't purchased an asset recently, in the past years. A lot of times these are developers that are expecting their newer product that is halfway leased up to to sell at a cap rate that, maybe 12 months ago was 4 cap. Now it's a 5 cap. So they need to come up with creative ways to hold on to their property a little bit longer for it to be leased up. Maybe they'll refinance, but they have this high expectation of uh, maybe their expectation is 250 a door, 250,000 a unit, whereas in reality it's actually worth 225,000. You're seeing a huge delta. I think it's slowly merging and getting smaller. These margins are getting smaller. Maybe it was 250 to 200 maybe 6 months ago. Now it's probably 220 to 250. I'm just making up numbers here, but there's still a gap of what buyers can actually pay for a property, and where these sellers are expecting to sell the properties. And that, or maybe the seller's backing into returns and they can't sell it. Just simple math that they'll lose money if they sell the property now. You'll see a lot of developers that have a lot of properties under construction bite the bullet and sell the properties. Maybe they have deep pockets, or they could move that those funds over to new projects. So it really depends on the developer, but there's still the vast majority of developers and operators, there's still a high expectation um, from their selling perspective. So that's causing a lot of the, I think, decrease in transaction volume as well. And I think slowly but surely we'll see that again merge. And eventually I think they're going to have to sell their properties, whether their debt is inevitably going to mature and they have to sell. They can't refinance because it might be a cash in of, millions of dollars, or whatnot. But I think over the next, this is a prediction. I don't have a crystal ball by any means, but just conversations I'm having, you're most likely going to see transaction volume increase over the next 12 months, just for the simple fact of your debt. You have a lot of looming bridge debt. You have a lot of units coming online in markets like Nashville, Austin, Texas, where I reside, um, Miami, Florida, let's see, Salt Lake City, Charlotte, North Carolina. You have all of these developers building new product that are not intending to hold these long term, 5-10 years by any means. They're looking to build these properties, lease them up, sell them. And you have, I think, for an example, in Austin, Texas, you have 18% of inventory coming online in the next 12 months. I think it's supposed to hit September of next year is like the vast majority of it. So if you think about that in the perspective of just developers that sell normally, you're going to see a lot of transactions, or the transaction volume definitely increase compared to 2023 as a whole. So just something to keep an eye out. I think sourcing deals will become a lot easier in the next couple of months. Maybe not now until the end of the year, but I think come January till September of next year, you're definitely going to see a lot more opportunity as a buyer compared to a seller. So keep an eye out for that. I think I might wrap it up here shortly. It's been 20 something minutes and I'm a fast talker, so I think I got through all the points that I wanted to talk about. I see one question come in. Can you speak a little about your process to find these motivated sellers? Yeah, I think a lot of it is word of mouth with brokers. So you have a middleman in all these transactions, majority of the time, 99% of the time. These brokers, their main relationships come with sellers, people that are in a position that have a large portfolio or developer that they know they're going to sell. I think a broker's least favorite person is a family office that holds the asset for their entirety, their entire life, because they can only sell that one time. Whereas, developers, they're going to continuously sell. So brokers are in meetings all day long with sellers, and they will tell you who's a motivated seller. If they like, if you have that relationship built, they're going to say, okay, XYZ Capital is a motivated seller. They have a lot of debt that's maturing. They're in a position where they don't know what they're going to do. So keep an eye. You have another person over here that says, okay, this person wants to sell their assets, but they're waiting, 3 more months, so keep an eye. A lot of the conversations I have with brokers today is just talking about specific operators. Are these guys sellers? Can we target their portfolio, whatever it may be? And a lot of that just comes with, years of talking with these people, meeting them in person for meetings or dinners or round of golf, just having some sort of relationship with these people that are in positions that know all of these operators. I'm not going to go out to 10, 15 operators and ask them, hey, when you get, they're not going to pick up my phone. They don't care about, my wants, but brokers, it's their job. Ultimately, they're going to sell these assets for them. So those are my number one resources for finding motivated sellers. I hope that answers your question, Michael. Great question. I think at the end of the day, sourcing deals, your number one asset are brokers, hands down. It's their job. They're day in, day out talking to these people that are going to sell assets. They know what's going on. They know that a lot of these big fish that are usually big buyers, Blackstone, the Cortlands of the world, are a little bit more sidelines than they used to be. They're actually motivated to sell. So they know what's going on and they're going to communicate that to you. If they like you and respect you and whatnot, I don't know. That's a topic for another day of just creating those relationships. And we definitely have talked about those topics. It's definitely in the book here. So can you speak anything about Waco, Texas market? Chip and Joanna Gaines have changed that market. I don't know too much about Waco. Personally, we don't have any assets there. I know it's a great market. It's not far from Austin, Texas, and I think it's definitely in the path of growth. But I would definitely do some research. There's definitely market data out there that's accessible to the general public. If you look at the major brokerage firms like CBRE, Marcus and Millichap, IPA, who is Marcus and Millichap. Let's see who else puts out good data. Walker Dunlap puts out good data. There's endless resources that are free. Actually, even Yardi Matrix puts out free data on specific markets if you want to look at vacancy rates and cap rates, anything, growth rates, projected growth rates, rent growth rates, whatever you need, they typically have it. On that note, I'm going to wrap it up. If you guys want to reach out to me, my email is chris@passiveinvesting.com. Feel free to reach out with any questions, concerns, threats, whatever. But thank you very much for joining today. I think next week we have another great speaker, same time. Yeah, so I'm going to end it here. Thank you for joining.